Paul, I'm going to make you earn your pay. I'm going to hit around on a bunch of different things, so I hope you had a good breakfast and you're ready to go.
Let's rock and roll.
Paul, I want to start off by talking about the Treasury markets. I've been looking at the 5s, the 10s, and the 30s. They all rallied yesterday, sending yields lower after that really weak retail sales number. But this declining yield seemed a bit muted to me versus the warning that the Fed board governor, Lael Brainerd, provided to us in regards to the potential downside risk of the economy. Were you surprised by not a bigger move in all three of those Treasury products?
Not really, because if you take a look, what we've seen is a huge rally in treasuries, really from the December peaks, if you will, when the Fed did their pivot. So really this is kind of a piling on, if you will, and we're kind of long in the tooth, as we are in the equity markets, of a rally in the treasuries. So we've seen yields come down significantly. What's interesting to me, though, is the yield curve itself really hasn't changed much. And the curve that we look at is the T-bills to the 20 or 30-year bond, or even to the 10. You're still in that mid-teen range. We haven't really re-steepened the curve. We really haven't flattened much out from the 210s. So when you're looking at the yield curve, it's still projecting the same non-recessionary risk. But we can see treasuries, I think, over the next maybe 3-4 months or so, continue to rally. We picked up a signal early in December that we were looking at lower interest rates, and we're still on that path. So I think it's a continuation of a Fed discussion of lower rates, longer rates, probably not raising rates.
All right, so one of the things, Paul, I wanted to follow up on was another comment from Governor Brainerd, because I'm curious about your thoughts about the potential impact, especially on this yield curve, and that was her comments that the Fed may change its course of action by it's been currently allowing $50 billion per month of treasuries and mortgage-backed debt to roll off its balance sheet. And what she's saying is, look, we need to stop that, and in fact, maybe perhaps the Fed could become buyers. My question here is, does this start to alter where that yield curve starts to have the impact across both the short and the longer term sides?
It can, because if you take a look at the Fed balance sheet actually is concentrated a lot in the 10-plus year range. That's where they really did all of their buying. So the impact we would expect to be on the long end of the Treasury curve, not necessarily at the short end. So again, there could be some impact. What's interesting to me is that discussion opening the door again for more quantitative easing. So the thought of we need to raise rates in order to cut them in case of a recession, pretty much out the door, because the playbook is now very open following the Japanese model of 20 years ago. So the Fed now has a lot of resources at their disposal for any possible recession we may wind up with.
Is there anything in some of this economic numbers, Paul, that maybe, I mean, she's the first governor to come out and actually actively make this comment. Is there anything in the economic numbers that are coming through, maybe even that unemployment number coming up here at the end or the beginning of next month, that could start to shift this thinking a little bit? Or do you feel like this has really been baked in and we're moving forward, sort of that playbook's open and the rest of 19 is kind of sort of set up here unless something dramatically changes in the next 2, 3, 4 months down the road?
Yeah, I mean, if you take a look at the expectation in the futures markets, really for no rate increase this year, we're penciling in one maybe mid-year. The economic data is okay. We discount the retail sales numbers yesterday, but the inflation data is coming in as expected. The employment numbers are good, inconsistent with where they've been. So really the Fed has hit their mandate, if you will, of full employment and stable prices. So for them to say, yep, we need to raise rates from here, I don't think we really need to. The economy is coming off of the tax cut high earlier last year, and we're back to trend line growth of 1.5% to 2% per year, which is more in productivity and demographics, which is going to be very difficult to change quickly. So I think the Fed is going to need to be on the sideline for much of this year and maybe even into next year.
So, Paul, I'm going to pivot away from the treasuries here. I think that's some great knowledge and some insight there. And I want to talk currencies, but I don't know that you can start any conversation with currencies or about currencies without talking about the U.S. dollar and what a juggernaut it has been since the start of February. You know, it's moved from 94.875 on January 31st, touching to a high of 97.12. My question to you is there anything that can stop this U.S. dollar move up?
You know, it's now back in that 95 to 100 range that we've seen over the last couple of years. It briefly got above 100, briefly below 95, but if you pull out that chart and go back about 2-3 years, we're back in that range. When you look at the economic data globally, the U.S. is really the best house in a lousy neighborhood, and I think that's part of the reason for that strength. You're seeing interest rates flat or down in a lot of other countries. Rate cuts still in like India and other places that are giving the reason for a lot of investors to flock to the dollar. So the strength in the U.S. economy relative to the rest of the world is really, I think, what's driving the U.S. dollar and creating havoc still for a lot of global economies as well as trade.
So, Paul, I'm going to move away from sort of the Asia area. I know we didn't touch on the yen, but I want to move over into Europe because it's been kind of an interesting one for me as I've been looking at it. But before I give you the obligatory Brexit question, I want to actually start off by just talking about the pure Eurozone and about the euro itself. It's been what I'd say is an interesting week. You had weak Eurozone data come through. You had sort of the continue to move down the path from Draghi and the ECB. But then yesterday you had really weak German data come out as well. And so my question here is what can be done, if anything, from the euro standpoint to keep it as it just kind of continues to have this slow grind down?
Yeah, you're right, and it is a slow grind down, and it is actually following in the same path, in a parallel path, if you will, with the pound, and we all know the reasons there. But you're right, Europe is still suffering, and again, going back to the comments about the U.S. being the best house in the lousy neighborhood, Europe is in a lousy, not a great house in that lousy neighborhood. And I think unless their data can start to turn around, monetary policy is on hold. Draghi has talked about raising rates, maybe cutting their purchases, and it's going to be difficult to do. And I think there's some concern in Europe about who replaces Draghi in the fall. And certainly I think the front runner is from Germany and really more of an inflation and monetary hawk. So we could see a change or a pivot away in policies. That may create a little bit stronger euro, but right now the data really isn't supporting and has not supported, whether it's from Germany or Italy or Spain, a stronger euro, and they're really struggling to get things going there.
So, Paul, we got just a quick moment here left, and I'm going to give you the Brexit question. I think everybody's kind of beaten it to death, but I think my question for you is, you got another no vote coming out, or no confidence vote out of the British Parliament yesterday. Basically, you're a little over a month away. My question here is there anything, you got one more vote coming down, is there anything that's going to make this Brexit exit be less than hard? Is there anything we can see, or is this British pound just going to continue to be treated like the euro and have a beatdown?
Yeah, I think what's going to happen is they're going to do the politically expeditious thing and punt. I think what's going to happen is they're going to get to that deadline, and then they're going to postpone that deadline maybe 3 months. There is some talk that they may go back to the population for a revote now that everybody understands what the implications of a Brexit might be. So I think there's still some moving parts there. I would be surprised if we pass the deadline and we get to a hard Brexit, because you would really see some additional problems in both England as well as on the continent. And I just can't see them willingly going down that path.